China just made one of the most aggressive financial moves we have seen in decades. And I'm not talking about some subtle policy shift or a quiet rebalancing of their portfolio. No. China is actively, aggressively dumping U.S. Treasury bonds at a pace we have never seen before. And if you own gold or silver, or if you've been on the fence about buying, you need to pay very close attention to what I'm about to tell you. Because what's happening right now could send precious metals absolutely parabolic. Now, before you think this is just another clickbait headline, let me show you the actual data. Let me show you the Treasury International Capital reports. Let me show you what the smart money is doing right now. Because by the end of this video, you're going to understand exactly why China is doing this, what it means for the US dollar, and why gold and silver are about to enter a phase that most people are completely unprepared for. Let's get into it. Okay, so let's start with the facts. According to the latest Treasury International Capital data, also known as TIC Data, China's holdings of U.S. Treasury securities have dropped significantly. We're talking about a reduction of tens of billions of dollars in just the last few months alone. And this isn't new. This is a trend that has been accelerating. If you look at the chart going back to 2013, China held over $1.3 trillion in U.S. Treasuries. Today, that number has fallen dramatically. They have been systematically reducing their exposure to American debt. But here's what makes this moment different from previous sell-offs. The pace has picked up. We're seeing month-over-month declines that are getting larger, not smaller, and it's not just China. Japan, the other massive holder of U.S. debt, has also been trimming, but China is leading the charge here, and they're doing it with purpose. Now, you might be asking, why? Why would China sell off the very bonds that have been the backbone of their foreign reserve strategy for decades? And that's where this gets really interesting. There are three main reasons China is dumping U.S. bonds right now. Reason number one, de-dollarization. China has been very vocal, along with the rest of the BRICS nations, about reducing their dependence on the U.S. dollar. They want to build an alternative financial system. They want to conduct trade in their own currencies, the yuan, the ruble, the rupee, and to do that, they need to move away from the dollar. Selling U.S. treasuries is a direct way to reduce dollar exposure. Reason number two, geopolitical tensions. Let's be real. The relationship between the U.S. and China has deteriorated significantly. We've got trade wars, technology export bans, semiconductor restrictions, tensions over Taiwan. China sees the writing on the wall. They saw what happened to Russia when billions of dollars in reserves were frozen overnight after the invasion of Ukraine. China does not want to be in a position where the U.S. can weaponize the dollar against them, so they're getting out before that can happen. Reason number three, and this is the big one that most people are missing, China is using the proceeds to buy gold. Massive amounts of gold. The People's Bank of China has been on a historic gold buying spree. Month after month, they've been adding to their reserves, and many analysts believe the official numbers are actually understated. Some estimates suggest China's true gold holdings could be 2 to 3 times what they officially report. They're converting paper assets, U.S. treasuries, into real, physical, tangible wealth. And that, my friends, is the most bullish signal for gold and silver that you could possibly imagine. Now let's talk about what this means for the U.S. dollar. Because if you understand the dollar, you understand why gold and silver are about to explode. Here's how this works. When China sells U.S. Treasury bonds, they're essentially selling dollars. They're taking dollar-denominated assets and converting them into other currencies or, as we just discussed, into gold. This puts selling pressure on the dollar. More supply of dollars in the market means the value of each dollar goes down, basic supply and demand. But it gets worse, because China isn't the only one selling. We're seeing a broad-based move away from U.S. treasuries by foreign central banks. Countries in the Middle East, Africa, Southeast Asia, they're all watching what China is doing, and they're starting to follow suit. The share of global reserves held in U.S. dollars has been declining steadily. It used to be over 70%. Now it's fallen below 60%, and it's still dropping. And here's the thing that nobody is talking about. The U.S. government needs foreign buyers for its debt. The national debt has crossed $34 trillion. The budget deficit is running at nearly $2 trillion per year. The U.S. Treasury is issuing massive amounts of new bonds to fund government spending. If foreign buyers like China are stepping away, who's going to buy all this debt? The answer? The Federal Reserve. They'll have to step in and monetize the debt, which means printing more money, which means inflation, which means the purchasing power of your dollars goes down even further. It's a vicious cycle, and we're watching it unfold in real time. Now, let me show you something on the dollar index, the DXY. If you look at the chart, the dollar has been weakening. It's been making lower highs. The technical picture is deteriorating. And when you combine the technical weakness with the fundamental story I just laid out, China dumping bonds, de-dollarization accelerating, the Fed potentially having to print more money, you get a recipe for a significantly weaker dollar. And what happens when the dollar weakens? Gold and silver go up. It's that simple. Gold and silver are priced in dollars. When the dollar loses value, it takes more dollars to buy the same ounce of gold or silver. This is the inverse relationship that has held true for decades, and it's about to kick into overdrive. Now let's get to the part you've all been waiting for. Why gold and silver are about to go absolutely parabolic. Let's start with gold. Gold has already been on a massive run. We've seen it break through all-time highs and push into uncharted territory. But I believe we're still in the early stages of this move. Here's why. First, central bank buying is at record levels. It's not just China. Central banks around the world bought over 1,000 tons of gold last year. That's the highest level on record. Poland, India, Turkey, Singapore, they're all stacking gold like their financial survival depends on it. Because frankly, it does. These central bankers see the same thing I'm telling you right now. The global financial system is shifting, and gold is the ultimate safe haven. Second, institutional money is starting to flow in. The gold ETFs have seen significant inflows recently after years of outflows. Big money managers are starting to allocate to gold, and when institutional money moves into a relatively small market like gold, the price impact is enormous. Third, and this is critical, real interest rates are likely to fall. The Federal Reserve is under immense pressure to cut rates. The economy is showing signs of strain. The labor market is softening. And when real rates fall, gold historically surges. This is because gold doesn't pay interest. When bonds and savings accounts are paying high real returns, gold looks less attractive. But when real returns are falling or negative, gold becomes the go-to asset. And we're heading straight into that environment. Fourth, there's a massive short position in the paper gold market. The COMEX futures market has a staggering amount of paper gold claims relative to the actual physical gold available for delivery. If even a small percentage of those contract holders demand physical delivery, the system would seize up. The price would have to reset dramatically higher to reflect the true supply and demand picture. We've seen small squeezes already, but the big one, the one that sends gold to prices most people think are impossible, that's still ahead of us. Now, what kind of price targets are we talking about? Look, I'm not going to sit here and give you a specific number and pretend I can predict the future to the dollar. But based on the money supply expansion we've seen, based on historical inflation adjustments, based on the debt to GDP ratios, credible analysts are projecting gold to reach $5,000, $7,000, even $10,000 per ounce in this cycle. And I know that sounds insane, but let me remind you, people said $2,000 gold was insane too. And here we are. But here's where it gets really exciting, because as much as I love gold, silver might be the bigger opportunity right now. And here's why. Silver has a dual role. It's both a monetary metal and an industrial metal. About 50% of silver demand comes from industrial applications. Solar panels, electric vehicles, 5G technology, AI data centers, medical devices. Silver is essential for all of these industries, and demand is growing exponentially. Let me give you some numbers that will blow your mind. The solar industry alone is consuming record amounts of silver. Each solar panel uses silver paste for its conductive pathways, and as the world pushes toward renewable energy, the demand for silver from solar is projected to double or even triple over the next decade. China, ironically, is the world's largest manufacturer of solar panels. They know exactly how critical silver is. That's another reason they're positioning themselves in precious metals. Now here's the supply side of the equation, and this is where it gets really scary. Silver mine supply has been essentially flat for years. We're not discovering new major silver deposits. Existing mines are depleting. And because silver is often mined as a byproduct of copper, zinc, and lead mining, you can't just ramp up silver production in response to higher prices. It doesn't work like that. The supply is inelastic, so you've got rising industrial demand meeting flat or declining supply. That alone should send prices higher. But then you layer on the monetary demand, the investment demand, from people who are buying silver as a store of value, as a hedge against inflation, as protection against currency debasement, and the supply deficit becomes a crisis. The Silver Institute has projected a structural supply deficit for silver that is expected to persist for years. We're already in deficit. The world is consuming more silver than it produces. And COMEX inventories have been declining. The registered silver available for delivery on the COMEX has dropped significantly. We're approaching levels that could trigger a genuine supply crisis. And here's the kicker, the gold to silver ratio. Historically, this ratio has averaged around 50 to 60, meaning it takes 50 to 60 ounces of silver to buy 1 ounce of gold. At certain points in history during precious metals bull markets, that ratio has dropped as low as 15 or 20. Right now, the ratio is still elevated. Silver is historically undervalued relative to gold. When this ratio starts to compress, and it always does during bull markets, silver doesn't just go up, it goes parabolic. It outperforms gold by a massive margin. Think about what that means. If gold doubles from here, silver could triple or quadruple. If gold goes to $5,000, silver could easily be $100, $150 or more. The leverage in silver is incredible. And that's exactly why I've been pounding the table about silver for months now. But it's not just about price appreciation, it's about preserving your purchasing power. Your dollars are losing value every single day. Inflation may have come down from its peaks, but it's still eroding your savings. The cost of housing, food, healthcare, education, everything is more expensive. And it's going to keep getting more expensive as long as governments keep spending money they don't have and central banks keep enabling them. Silver and gold are the antidote. They've been money for 5,000 years. They can't be printed. They can't be debased. They can't be frozen by a government. They are the ultimate form of financial sovereignty. And let me add one more thing about silver that most analysts completely overlook. Silver is consumed. Unlike gold, which is hoarded and recycled, a huge portion of the silver used in industrial applications is gone forever. It's used in such tiny amounts per device, a fraction of a gram in each solar cell, each circuit board, each medical instrument, that it's economically unviable to recycle it. That silver is lost, it goes into landfills, it's dispersed into the environment, which means the above-ground stockpiles of silver are actually shrinking over time. Some researchers estimate that there is actually less refined silver above ground today than there is gold. Think about that. Silver is rarer than gold in terms of available investment-grade supply, and yet it trades at a fraction of the price. That disconnect cannot last forever. The market will eventually recognize the true scarcity of silver, and when it does, the repricing will be violent and fast. Let me also point out what's happening with silver premiums. If you've tried to buy physical silver recently, you know that premiums over spot price remain elevated. Dealers are charging significantly above the paper price because physical silver is in high demand and tight supply. This is the market telling you something. The paper price on the COMEX does not reflect reality. The real price of silver, the price you actually have to pay to get metal in your hands, is already higher than the quoted spot price. And as this disconnect grows, eventually the paper price will have to catch up to the physical market. That adjustment alone could add dollars per ounce to the silver price overnight. Now let me show you what the smart money is doing, because this is a huge confirmation signal. We already talked about central banks loading up on gold. But it's not just central banks. Some of the biggest names in finance are positioning for exactly what I'm describing. Legendary investors have been increasing their gold allocations. Major hedge funds have been building positions in gold miners and silver miners. Even the big banks, the same banks that have been suppressing precious metals prices for years through paper manipulation, are now turning bullish. Look at the TIC Data, the Commitment of Traders report. The commercial short position, while still large, has been shifting. The smart money commercials are starting to cover their shorts. They can see the writing on the wall. When the entities that have been keeping a lid on prices start stepping aside, there's nothing left to hold prices back. And then you've got the retail side. Silver stacking communities have exploded. The movement that started a few years ago has only grown stronger. Millions of people around the world are buying physical silver, coins, bars, rounds, and taking delivery. They're pulling metal out of the system. They're reducing the available supply for industrial users and futures traders. This is a grassroots movement that is combining with institutional demand and central bank buying to create a perfect storm for precious metals. We're also seeing massive investment into gold and silver mining stocks. The mining sector has been undervalued for years. These companies are sitting on assets in the ground that are worth dramatically more as metal prices rise. The profit margins for miners expand exponentially as gold and silver prices go up because their costs are relatively fixed. A gold miner that's barely profitable at $1,800 gold becomes incredibly profitable at $3,000 gold. The leverage in mining stocks is enormous, and institutional money knows this. And there's another signal that I find incredibly telling. The physical gold markets in Asia, Shanghai, Dubai, Mumbai, have been trading at persistent premiums to the Western paper markets. That means buyers in Asia are willing to pay more than the COMEX spot price to get their hands on physical gold. This premium tells you that the real demand for physical metal is outstripping what the Western paper markets suggest. It's a two-tier market now. The paper price is one thing, the physical price is another, and eventually these two prices will converge, and they'll converge upward toward the physical price, not downward toward the paper price. I also want to mention something about the BRICS nations more broadly. It's not just China. Russia has been accumulating gold for over a decade. India has been a massive buyer. The UAE, Saudi Arabia, they're all diversifying into gold. There's growing speculation that the BRICS bloc may eventually introduce some form of gold-backed settlement mechanism for international trade. If that happens, even partially, the demand for gold would explode beyond anything we've seen. The amount of gold needed to back even a fraction of global trade would dwarf current supply. This is the end game that many gold analysts have been talking about, and with every passing month, it's looking more and more realistic. Okay, so the big question everyone wants to know, when? When does this all play out? Here's the honest answer. We're already in the middle of it. This isn't a prediction about something that might happen in the future. This is happening right now. China is selling bonds right now. Central banks are buying gold right now. The dollar is weakening right now. Silver is in a supply deficit right now. All the pieces are in place. But I believe the real acceleration, the parabolic phase, is likely to kick in over the next 12 to 24 months. And there are several potential catalysts that could trigger it. Catalyst number 1, a Federal Reserve pivot to rate cuts and potentially even quantitative easing. When the Fed starts cutting rates aggressively, and especially if they restart QE, money printing, that's rocket fuel for gold and silver. And given the trajectory of the economy and the debt situation, this is looking increasingly likely. Catalyst number 2, a COMEX delivery failure or supply squeeze. If the physical metal simply isn't available to meet the paper claims, the entire price discovery mechanism breaks down. Prices would have to reset dramatically higher overnight. This is a low probability event in any given month, but the probability is increasing as inventories decline and demand rises. Catalyst number 3, a geopolitical escalation. Whether it's Taiwan, the Middle East, or something we can't even predict, any major geopolitical crisis will send capital flooding into safe haven assets. And in a world where trust in government bonds is eroding, gold and silver become the ultimate safe havens. Catalyst number 4, a banking crisis. We saw the regional banking stress last year. The commercial real estate market is under severe strain. There are hundreds of billions of dollars in unrealized losses sitting on bank balance sheets. If another banking crisis erupts, the Fed will have to intervene with massive liquidity. And history tells us that when central banks flood the system with liquidity, precious metals are the biggest beneficiaries. Any one of these catalysts could be the spark. And with all of them sitting on the table simultaneously, the question isn't if gold and silver go parabolic, it's when. And the answer is probably sooner than most people think. So what should you do with this information? Look, I'm not a financial advisor, and I can't tell you what to do with your money, but I can tell you what I'm personally doing and what I think makes sense given everything we've discussed. First, I believe having a portion of your savings in physical gold and silver is one of the smartest things you can do right now. Physical metal that you hold in your own possession. Not paper gold, not ETFs, not futures contracts, actual physical, in your hands, precious metals, because in a crisis, counterparty risk matters. You want to own the metal, not a promise to deliver the metal. Second, dollar cost averaging is your friend. Don't try to time the bottom. Nobody can do that consistently. Buy a little bit every week, every month. Stack consistently. Over time, your average cost will smooth out and you'll build a meaningful position without having to stress about short-term price movements. Third, diversify within precious metals. I love silver for its upside potential, but gold provides stability and is the ultimate insurance policy. Having both makes sense. The ratio you choose depends on your risk tolerance and your financial situation. Fourth, educate yourself. Keep watching videos like this. Read the data. Understand the macro picture. The more you know, the more conviction you'll have. And conviction is what allows you to hold through the inevitable volatility. Because let me tell you, the road to higher prices is not going to be a straight line. There will be pullbacks. There will be days where silver drops 3, 4, 5%, and the mainstream media screams that the precious metals trade is over. Those are the days where conviction matters. Those are the days where the educated investor buys more while the uninformed panic sells. Let me wrap this up by bringing it full circle. China is dumping U.S. bonds. They're converting those dollars into gold. Central banks around the world are following their lead. The dollar's dominance is being challenged in a way we haven't seen in our lifetimes. Silver is in a structural supply deficit with explosive industrial demand growth. The gold-to-silver ratio is screaming that silver is undervalued, and the potential catalysts for a parabolic move, rate cuts, COMEX squeezes, geopolitical crises, banking stress, are all lined up. This is not fear-mongering. This is reading the data. This is following the money. This is understanding that the global financial system is undergoing a seismic shift, and precious metals are at the center of it. If you found this video valuable, smash that like button. It helps the algorithm push this content to more people who need to see it. Subscribe if you haven't already, and hit the bell so you never miss an update. I'm covering this story every single day because I believe it's one of the most important financial developments of our lifetime. Drop a comment below. Tell me, are you stacking gold, silver, or both? What's your price target? I read every single comment, and I love hearing from you guys. I'll see you in the next one. Stay stacking, stay informed, and remember, in a world of paper promises, physical precious metals are the ultimate truth.